All right. Now I want you to understand the concept of the perfect price movement. Here, you can see the Bitcoin chart in front of you. Note, the ideal price movement cycle consists of three main parts, right? 1. The uptrend channel, which includes 2 breakouts and 2 waves. 2. The sideways phase, where the market stabilizes before the next move. 3. The downtrend channel, also with 2 breakouts and 2 waves. Let's analyze this further. You might be wondering why I call it the perfect price movement instead of the perfect price cycle, right? As we analyze, this will become clear to you. Now, if you look at Bitcoin's movement here, you'll notice that it was in a sideways phase before breaking out and forming an uptrend. Let's start by defining the channel. First, go to the Tools menu and select the Parallel channel. Then, identify the beginning of the uptrend, starting from the lowest point of the first pullback. Extend the channel upwards, then click again to create the secondary line and place it at the highest peak here. You'll notice upon zooming in that I've connected the lower trend line of the channel to the key pullback levels of the uptrend. Let me highlight them for you. Do you see these 2 circles? These mark the pullback levels where the lower trend line should pass through and align with them to ensure the channel is drawn correctly. Now look at the other pullback levels. They are respecting the lower boundary of the channel. Look, I did not draw the channel randomly. I need to identify the pullback levels. I need to remove the circles. You will find here that there is a gap in this shape. You will see that there is something wrong with the other pullback levels in the uptrend. I need to make sure that the lower trend line passes through the pullback levels of the uptrend. Oops, I accidentally deleted the channel. I will delete this circle as well. I need to adjust the chart so that it becomes clearer here. You can adjust it from the side and the bottom. Now look at this upward movement. Let's make the channel more organized so that our analysis is precise. Now, look at this first breakout. Since it did not respect the lower trend line, the price dropped by $5,000. Then, look at the candle body. The part of the red bearish candle outside the channel is larger than the part inside the channel, isn't it? Look, after the first breakout occurred, the first wave was confirmed. I will mark it for you. Let's select this tool. Now I will identify the first wave. Let me clarify it for you. Do you see it? This is the first wave after the first breakout of the channel. Now, just by looking, you can identify the second breakout and the second wave. Right? Let's mark it using the same tool. It is a smaller wave than the first one, and it doesn't have to be exactly the same because buyers and sellers are constantly changing. Now, look at the sideways movement. Do you notice it? It doesn't follow a clearly upward or downward path. It's fluctuating, which is known as overbought saturation. Let's mark it using the same parallel channel tool, but this time we will draw it horizontally. Now, let's select the tool and mark the sideways movement by drawing it. I refer to marking with tools as drawing. I've gotten used to it. Now let's highlight it with a distinct color so it becomes clearer. Do you see this fluctuation? It represents an overbought saturation after achieving the ideal price movement for the upward trend. Do you see the low points? They align with the same level as the second break after the first wave. This gives you an idea that past price action is important for future analysis and technical study, and that price movements tend to closely resemble previous patterns. Now, you might be wondering why I called it the ideal price movement instead of the ideal price cycle. Look at the downtrend along with the formation of the sideways movement. Does this downtrend have the same characteristics as the uptrend we previously identified and drew? Of course not, because the ideal price movement cycle requires an upward channel with a break, a first wave, another break, and a second wave. The same applies to the downtrend. After the formation of the sideways movement or the equilibrium between buyers and sellers, a downtrend will form, consisting of a channel, then a break of the channel, followed by a first wave, a secondary break, and then a second wave. You won't always get an ideal price movement cycle every time. You may find it in a downtrend without an initial uptrend.